Back to Homes Today. This will be presented here by beautiful Audrey Forche, who's a dynamic realtor at Remax Realty. Audrey is also a superb advisor. On this good Sunday morning, Audrey is once again found alongside a well-known financial advisor by the name of Mike Brozovac. The topic of discussion on this set will be downsizing. That's right, downsizing. Let's view that together.
Hello friends, welcome back. Thanks for joining us today. My name is Audrey Forche and I'm a Remax agent in Montgomery County, Maryland. And again, we have our friend, financial planner, Michael Brozovac. Hi, thanks for joining me again.
Thanks for having me.
Always such great information. I could ask you questions for hours on end. Today our subject is going to be on downsizing again. I think we've talked about it a little bit before, but I think that as all of us baby boomers are aging and figuring out what we're doing with our money and stuff, I think it's a good subject to talk about. Maybe we'll look at it from a little bit different perspective today. So one of the biggest challenges I think for downsizing is all our stuff, right?
Yeah.
And you said that a lot of people don't want to move.
They don't. They've collected stuff for over 10, 15, 20, sometimes 30 years in their house. And it's just such a daunting task that they decide, I'm just going to stay here. You know?
They don't go down south. And I have a lot of that. I do have a lot of people that are packing up their family homes and they're selling them. But there are those people that there's so much stuff they just don't even know what to do. A company that I found, and I'm not sure if I've mentioned them before or not, and they helped one of my clients and I thought they did a really great job, is a company called Legacy Navigator. I don't get any kind of endorsement from them, but I think if you are someone that has a lot of things, you're not sure what to do with them. A lot of our kids don't want our family heirlooms anymore, do they? Or furniture or antiques or any of that stuff. Legacy Navigator really is great, and they're good with people, and they help you get your house organized, declutter. They'll donate, they'll sell, and then they'll trash some of your stuff. So look them up if you're trying to declutter your house. So if you do decide to sell your home here, and you're going to go south, like a lot of people do go south to the warmer weather, cheaper taxes in some places, right?
Florida, there is no state income taxes, so that's where a lot of people end up.
Oh, that's right. So let me ask you this. If I'm selling my family home and I'm going down to Florida, is it better for me to buy a house or should I rent a house? What are your thoughts on that?
We always recommend before you go, unless you've been there for quite some time, we will always recommend that you rent first. Okay? Especially when you go to places where everybody flocks to during the winter time. It's a lot different from January to, let's say, April than it is during the summer. And you'll see your neighbors change over, you know, so they won't be the same neighbors while you're stuck year round over there. So we always say, you know what, it's cheaper to rent versus to purchase a home, as you know.
Right.
Okay, and find out that you made a mistake.
Okay, yes, definitely.
So
it would be better, and plus because you have people that will do the maintenance for you. You don't have to keep up with the, fixing the air conditioner or replacing the roof and all those kinds of expensive maintenance items too. So in terms of, I've sold my big home, we know that what's the exemption for that?
So that stays the same. It did not change for the tax code, which is great because people thought that may change and they would get rid of that. So you have a exemption of $500,000 if you're married.
Right.
Okay, so you can exclude $500,000 out of capital gains for your house.
Okay.
And as long as it's your primary residence and you've lived there 2 out of 5 years.
And it doesn't have to be concurrent either.
It does not have to be consecutive.
Okay. So that most of us fall into that category. It's your family home, you've lived there. So, and you go down and you rent a property, I guess you're not, if you own your property free and clear and you don't have a mortgage, you're not looking to take a mortgage out anyway. So renting, there's not really a tax benefit in terms of a mortgage write-off or any of that jazz.
No, and it's different for everybody. It really is. So you really need to sit down with your CPA and figure out, because of the changes, these are pretty significant changes that just took place for
Right.
this year. So a lot of people are now limited to $10,000 on their state and local income tax.
Okay.
So, and mortgages have also changed too.
Right.
So starting now, only interest up to $750,000 on a mortgage
Right.
can be written off.
Right.
So, you know, you really have to look at this and see what best fits your lifestyle. But
Of
since
course.
we're talking about downsizing, a lot
Yeah.
of times you'll find a lot of people go through and sell a house that's 750, a million, or $500,000 up here, whatever that may be, and buy something in Florida as comparable, but only $200,000 or $300,000 or $500,000.
And just pay cash for it.
And pay cash for it.
Yeah. But I think renting is a good thing too, because if you rent, then like you said, what if, you know, you might not like that specific area, or you might want to live in a different area, or maybe it's too hot for you in Florida. Maybe you want to go to a Carolinas or something of that nature. So yeah, okay. So renting, I think that's probably a good thing, and probably, you know, probably a safe thing for most people to do. So, so let's talk about also, as you're downsizing and you're thinking about, you're living with no mortgage payment, but you do have rent to pay, and you're thinking that your Social Security might cover your rent, or you have your retirement account and everything together. So how are you going to budget for that? So let's talk about your Social Security. So we still have Social Security that we can get for right now. Is it better to take your Social Security when you're younger, or is it better to wait so it's a bigger payment and take it later? So how do you look at that?
That's a great question, and everybody has a unique situation.
Okay.
So general rule of thumb is you would want to wait till your full retirement age, which
Okay.
for most people is going to be 66 in some months.
Okay.
Okay. At that point in time, you can get your full Social Security.
Okay.
If you take it early and you work, you will have a reduction in benefits.
Okay.
Okay, so that's very important.
Okay.
So, and we will see that sometimes. So
Okay.
people will say, I want my Social Security, I'm going to take it at 62 or 63 years of age. And when you take it at that early age, you're already getting a reduction in benefits. So you're not getting, because
earlier.
you're taking it early.
Okay.
Okay. And then they may decide that, hey, retirement's not totally for me. So they may take a part-time job or go into consulting or maybe sell real estate down there, whatever it may be.
Right.
All of a sudden they're getting this income, and then the following year they realize that their Social Security is getting reduced, their Social Security payments, because they have earned income. Okay.
Oh, okay.
So you have to work with a financial advisor or your accountant if you do plan on taking Social Security early and you think you may have an inkling of wanting to go back to work.
And you can go and you can pay back into your Social Security. You can't do that anymore?
So the rules have changed.
Oh.
So it used to be you could go back if you made a mistake and you hit the reset button and pay back what you've taken out and reset that. You can still do that, but the time frame has shrunk down so much that you're going to miss it.
Yeah,
Okay?
so wait, probably
There's
better.
no reset button, as we call it anymore. And speaking of waiting, if you do wait, so let's say you don't need your money when you hit your full retirement age, for every year you wait, you're getting an 8% increase in your
Okay.
Social Security.
Okay.
And that will increase all the way up to the age 70.
Okay.
So you want to think about that.
So, you know, I do know that some people have said that if they take their Social Security early and they do work, they've taken that Social Security check and invested it in an investment account. Have you ever heard of people doing that kind of a thing? Does that really make sense for some people to do that sort of thing?
Yes and no. It depends on what kind of income they're bringing in.
Okay.
So if they're bringing in roughly less than $15,000 a year, then they're not getting a reduction in Social Security benefits.
Okay.
But if you're bringing in anything significantly over that, then they're reducing their Social Security, and that Social Security is reduced that year. So they're not really getting to be able to take the full benefit of that Social Security and invest it.
Okay.
It makes no sense.
Okay.
You know,
All right.
so we have a client that comes to us and says, I'm going to work at 64, but I want to take my Social Security. We're going to show them the difference of taking Social Security at 64 and working, and just working and not taking Social Security.
Okay.
Okay, and see which ones work out better for them.
So wait till full retirement and take your Social Security.
Everybody's case is different,
Okay.
you know, but generally if you have longevity in your genes, you know, the longer you wait, the better it is.
Okay, and so How long is the maximum time that I can wait to take my Social Security?
70. You have there's no benefit after 70.
Okay.
Okay, so if you take Social Security at 68 and say, well, maybe I'll wait a year and go to 69, you're going to get an 8% increase in your monthly benefit.
Okay.
Then you can say, well, I'll wait another year and go to 70. Well, you get another 8% increase in your benefit.
Okay.
But if you said, I'm going to wait till 71, there's no 8% increase.
So it's
so
over.
You're maximizing it at 70.
Okay. And so along with that, if you have your retirement account set up, and is it better to leave your money in your retirement accounts if you can live off your if you, let's say, 66, you want to start taking your Social Security, you bought a house, you paid cash for it, so you really just have the taxes and maybe some maintenance and your utilities and your insurance that you're paying for. Is it good for you to leave your money in your retirement accounts and hopefully they accrue a little bit more money? But you're probably at that age in some stable things like, our bonds. Are you in bonds at 60s, 70s? You want to be in kind of stable, not aggressive funds and stuff like that?
It all depends on your risk tolerance, but yes, you're probably going to have a mix, regardless if you're 60, 70, or even 80. You're probably going to have a mix of fixed income, which is your bonds, could be cash, could be CDs, and also in equities too. Okay. And it all depends on what that allocation is. But in general, when you retire and you're selling your large house up here, that's what we see a lot of people do, is sell their house up here and move to Florida. They're left with a pile of cash. Okay. And so it's great to work with your planner or work with your tax advisor to figure out the most economical way to pay for all your expenses, because you listed that definitely listed your no mortgage, but you've listed the home insurance and you have your property taxes. But you have to eat, you have to clothe yourself, you have to put gas in the car, and you certainly retired to go down there to enjoy life.
You certainly hope that, right?
Exactly. So that all takes money.
Yeah.
So what is the best way to get that money out of the accounts? And so any money taken out of your retirement accounts is taxable. It's as ordinary income tax. Okay. Social Security, to some degree, is taxable depending on what your adjusted gross income is. So there's all of these different measurements that you have to look at as far as what different brackets and what different income levels create tax for Social Security. Okay. And so as you're pulling the money out of your accounts, we like to think of it as 3 buckets. You have a taxable account, a tax-deferred account, which would be like your 401k or 403b or IRA, and then a tax-free account, which could be like a Roth IRA. Okay. And so what you want to do is maximize the amount of money you need each year by minimizing the taxes. And that's why you would want to seek out maybe your CPA's help or your tax accountant or your professional's help.
And so, but what's the latest I can wait till I have to take my money out of my IRAs and stuff?
Great question. 70 and a half. And we hear this a lot. So the year you turn 70 and a half, you have to start taking your required minimum distributions.
Is that for my Roth IRA or no? It's
just your traditional IRA, your 401k, and your 403b. Now, if you're still working when you're 70 and a half, then you're not a 5% owner in the company, wouldn't that be great?
Yeah.
then you don't have to take money out of your 401k. So
you don't have to.
If you're still working for that company.
All right. And then what about things, I know that when people are older and maybe they have saved some money and all that sort of stuff, and they might want to do like charitable donations or have a foundation or something like that. Is that something for older folks to consider?
It is. Again, we would ask them to speak with their tax professional, but when you're in 70 and a half, you can, instead of taking your instead of taking your required minimum distribution, you can make that distribution as a qualified charitable donation, and it doesn't hit your tax return.
But I have to, I mean, obviously you have to actually put it to a charity, and that's your, the 70 and a half when I have to take the money out of my IRA. I'm just trying to think myself how that all works. And then I'm gonna want to give it to a charity, so then I can write that off my taxes?
Well, you can't write it off your taxes, and we're kind of getting into the weeds here, but if you had to take $5,000 from your retirement account, that's gonna be taxable to you. You're gonna get a 1099-R. You're required to take that. But instead, you can say, I'm gonna donate that $5,000 to a charity,
Okay.
you're still going to get a 1099-R, but it's not going to be reported as income on your tax return, which could help you with other things.
I see. So, okay, well, I think that those are some pretty good things for us to take a look at and to talk about in terms of what we need to do as we age out, and all our baby boomers out there that are watching. We hope that this helps you, because you know it is very tricky to navigate, especially with all these new tax laws. And I said it before, I really believe that it's important for you probably to consult a CPA with all these new tax laws, or a financial planner, to make sure that you are getting the most benefit for your money. So I thank you again for coming. Thanks, Mike.
Thanks.
And we'll see you next time. Bye-bye.